Good afternoon, or good morning, or good evening if you're a long way west or east of Europe, and welcome to this ACT webinar looking at case studies in currency or foreign exchange risk. I'm Will Spinney. I'm an Associate Director of Education here at the ACT, and I'll be chairing this discussion today. We welcome back Chatham Financial, who've done webinars on foreign exchange risk and interest rate risk before. You can go back and look at any of these webinars on our website whenever you like. This webinar is going to last for 45 minutes. Well, foreign exchange was always at the top of, or pretty much near the top of my inbox when I was a treasurer, and treasurers are the go-to person really on FX risk, and of course it's also a large part of the syllabus in almost every one of our qualifications. But perhaps apart from the Swissy a while ago, things have been fairly quiet in the foreign exchange market recently, but one can't help thinking this may not last. And I think, if I'm correct, we might even be hearing a little bit about commodities in today's presentation as well. We have with us today from the Corporate Advisory and Financial Risk Management Division at Chatham Financial, Paolo Esposito and Anne Nguyen. We're going to listen about some case studies in FX risk management based on their experiences. I'm going to ask some questions as we go through, but you will have the opportunity to pose questions to Paolo and Anne as well. Let me just introduce you to a few of the technical bits of this webinar. There is a menu bar across the bottom of your screen that allows you to open various windows. You can move these around your screen, resize them, or minimize them during the webinar. And the slides will appear in one of those windows as well. Another button there opens the question and answer window. You can send in your questions by typing into that window. Please don't wait until the end of the presentations to send in your questions. Just send them in as they occur to you. We'll keep an eye on them throughout the webinar and pick out some big ones. We hope that we'll be able to get to a lot of them. Perhaps we won't, but we'll do our best. We will not disclose who has asked a question. If you've got any technical difficulties during the webinar, there's a green button with a question mark, and that's the window to head for. And finally, before we get started, we're going to put a recording of this webinar up onto our website in a couple of days, together with a separate copy of the slides. Okay, so Paolo, I think you're going to start, or is it Anne that's going to start us off today?
It is me, Will. Good morning. Good afternoon, everyone. So, my name is Paolo Esposito. Today we'll be looking at some case studies focusing on the first phase of financial risk management process. We will be focusing on the risk assessment. But before that, let me just introduce quickly our company, Chatham Financial, and hopefully many of the people attending will be familiar with us, with our name, and with our areas of expertise. But nonetheless, I'll just spend 1 minute to describe us and also to explain how we gather our experience in financial risk management. So we are a company that specializes in financial risk management, and we have expertise that cover the areas of interest rate, FX, commodities, and inflation. In the market, we believe we are among the few, if you're not the only ones, that can offer a combination of advisory and technology solutions. When we're looking at advisory, we work with companies, helping them understand the true nature of the risk. We help them developing policies to mitigate these risks, and we help them executing and implementing the actual hedging programs. In this activity, with regards to this specific execution phase, Chatham trades on behalf of the client roughly $500 billion every year. So every day we are on the market and we execute roughly $1.5 billion of derivative transactions, and that is making us experts in pricing and negotiating derivatives with the banks. Just closing on the technology solutions, we offer modules that value derivatives. We have a system that helps our clients applying hedge accounting, and a module of exposure management, which is effectively helping companies track their risks and determine the best strategies to mitigate these risks. Finally, looking at clients, we work roughly with 1,600 companies globally, and these are this is across various industries. Historically, we worked with private equity and real estate. More recently, we have a dedicated team that supports corporates. Personally, I'm responsible for our European corporate practice, and with me today we have Anh Nguyen, and she's co-speaking today, and she's our expert on complex FX advisory projects. So, today we will look at some case studies in the area of FX risk management, and we will start with a first theoretical example using a fictitious company just to introduce our approach, followed by 2 real case studies of clients that we've done work with. But before we do that, it's possibly useful to just start by introducing some basic concepts of around the definitions of FX risk management. So if you can move to the next slide. These are concepts that we have introduced in a previous webinar of ours. We will go through this pretty quickly, but it's just useful to have a common base of understanding on the concepts and on the terminology. So, how are companies affected by currency risk? We will look at a company that is denominated in GBP, and we will use a timeline that has 3 moments on it. We have the moment of now, when the company is forecasting a transaction, let's say a revenue in US dollar, that is to take place in 6 months. Then we have the 6-month time from now, when the revenue is booked in the accounts at the prevailing GBP US dollar rate. And then we have the 60 days later time, when the company receives the cash in US dollar. So from a risk point of view, between the first 2 moments, meaning between the forecast and the moment of the booking of the transaction, the company is exposed to the risk that the US dollar depreciates versus the pound, so that is worth less pounds at the time of booking. And this is a true economic risk, a real risk that can affect the economic margins of the company. So we can define this as margin risk. The second component comes from the time of the booking of the accounts receivable and the time of the receipt of the cash. And between this time, the accounts receivable will be booked at a rate and will be remeasured every single day depending on the prevailing GBP US dollar rate. So this change in the accounts payable or accounts receivable, depending if it's a revenue or a cost, can be defined as remeasurement risk. By the way, while margin risk has not got a separated indication in the financial statement of the company, and is only visible in the management accounts as a variance versus budget or versus forecast, when we look at the remeasurement risk, this is booked under a separate line in the FX gains and losses, so it's very visible on the P&L of a company. We will introduce 2 other terms that are very common in the terminology of financial risk management. We will look at transaction risk and translation risk. The first one, the transaction risk, represents the risk for an entity that has transactions in a currency that is different from the reporting currencies. As we said, a GBP-denominated company that has a revenue or a cost in US dollar. And we can see that this risk is consolidating and mixing the margin and the remeasurement elements of risk. There is then a second component of risk that is defined as translation risk. And this represents the risk that affects a company's financial statement on consolidation. And like we can see on the graph on the bottom right of the slide, it is the risk of translating P&L or balance sheet of a euro company into the group holding company in GBP. And just to be clear,
when you go into a company and have a look at all this, what do you take a look at the economic risk? This is the risk before ever, even a contract has been sorted out. It's the basic competitive position of a company, and also that sort of pre-transactional risk when a company publishes a price list that they keep open or puts a tender in. Do you look at those?
Yes, definitely. When we tend to look at defining the risks that are affecting one company, we look at a risk that is more, let's say, operational. It will be depending on how the business actually works. So in our case studies today, we will be looking at a company towards the end that really deals in projects. So these companies that tend to price a project and will need to wait 2-3 months before knowing whether the bid is won or lost, these companies would have another kind of risk that could be called pre-transactional risk. And we definitely work with companies that are affected by these components, and the mitigation strategies will be specific for this kind of risk. So really, the nature of the business determines a lot how the company is doing their forecast, how a risk is affecting a company or not. The way we split between margin risk and remeasurement risk, the reason why we do that is because these two components are affected by different choices. So the business model, by how long are the forecast cycles of a company, how long are the accounts payable and receivable cycles of a company. But also because these two components can be hedged in different ways. So companies that care a lot about the remeasurement risk will put in place programs that are different from a company that cares maybe about both.
Okay, thank you.
No, thank you. And just to be clear, in some cases, the transaction risk might not affect a company's cash flow, if a company is not repatriating, for example, but it does affect the EBITDA of a company. It does affect its earnings, its stock price. So it is an economic risk for a company. So we can leave it with this to Anne, that will introduce the concept of value at risk.
Thanks, Paolo. So with that basis of understanding of the different types of risk, I'm going to take you to a model that will utilize to understand the level of risk of a company. So what you're looking at here is a value at risk model, and some of you might be familiar with it already. So for different companies, this value at risk could be a net income at risk, an EBITDA at risk, or cash flow at risk. It could also be equity value at risk, and depending on the really priorities of each company and its shareholders and the board and senior management, the value at risk component that the company would care most about might be different. But regardless of what the ultimate value at risk that you care about, there would be 3 main components that really contribute to your overall risk level. And the first one at the bottom left there, we want to look at the magnitude and direction of exposures. And by that, we mean what currencies you're exposed to, in which direction. Do you have revenue in certain currencies? Do you have costs in certain currencies? And for example, a company, a UK company with 100 million of USD revenue expected within the next year would have an exposure to the USD. But at the same time, if that same company has an offsetting cost to the USD, then the level of risk to of the company to the USD would be much more reduced. If you imagine a different scenario where that same company has costs in renminbi or in Chinese yuan, the story might be very different there, and that's why we would want to include the correlations and volatilities component of the various currencies that you're exposed to as well. In order to really understand from a macro perspective the level of risk a company is facing, the magnitude and direction of exposures of the company would really have to come from your forecast, an understanding of the business. Like Will mentioned, each business might have various different life cycle of their transactions, and that would introduce different nature of risk. And from the market's input perspective, correlations and volatilities would further influence the magnitude and the level of risk of the company. How volatile a currency is and how that would impact the other currencies that you're exposed to in your revenue or your costs. would be another part of the story. So with all that input in mind, the 3 different buckets of information that you would need, you would be able to run a statistical analysis of what would be the expected outcome of your EBITDA, for example. So what you're looking at here is an example of a normal distribution curve, and you can see that this particular company would expect a mean EBITDA of around 300 million. You can see that the dark blue line with the widest distribution would be the fully unhedged position. So this company would actually have a risk of reducing their overall EBITDA as much as 20 million or increase that EBITDA as much as 20 million just simply due to FX movement. Once the company decide to hedge, or if you think about it as, if you can wave a magic wand and just make certain currency exposures disappear, what would happen then? So the statistical analysis that you can run on your exposures would allow you to really think about what happened if you don't have exposure in South Africa, if you don't have exposure in India or Russia, what would happen to your expected EBITDA outcome? So this is the background of the 3 case studies that we'll go into in a minute to really understand how companies can assess their overall risk level and quantify their risk in order to make appropriate business decisions and whether they should hedge or they should use other natural hedging strategies such as changing their costs or changing their revenue currencies. So I'm going to hand it back to Paolo for the first case study now.
Thank you, Anne. So with this first case study, we want to highlight the challenges for a company that wants to quantify its risks and to determine the most appropriate hedging strategies. We will start by introducing this company. It is a fictitious company that we will use to describe the practical application of the value risk methodology and to describe how this methodology can influence the selection of the most appropriate hedging strategy. So we're dealing with a company that is a single entity, is denominated in euros, and has purchases in Chinese yuan, in Czech koruna, and revenues in US dollar, Australian dollar, and Polish zloty. So we can see straight away that there is a significant mismatch in the cash flow that expose this company to currency risk. We assume that this company has no debt. When talking about risk, then, how does this company see risk? What do they care about? In this case, the key metric, so the metric that is the most important to the ownership, to the management, is net income. So the risk strategy, the risk management strategies will be assessed towards the benefits and the risk reduction on this metric of choice, the net income. So Anne mentioned the Monte Carlo simulation, and we use this methodology to quantify the net income. And we see that the net income, the expected net income, just a second, apologies, I think I'm on the wrong slide. Oops. So we were looking at the cash flows of the company, and we expect this company to have an average net income of 4.5 million. On the right side of the slide, we also see the cash flows that are positive in euro, US dollar, Australian dollar, and PLN, and are negative on CNY and Czech koruna. So how does this company should think about risk, and how should this company hedge in order to achieve its risk reduction priority of minimizing the volatility on the net income? We leave the audience with the 3 possible choices. So should the company hedge the biggest exposure, that is in CNY? Should the company hedge the most liquid currency, that is US dollar? Or should they hedge everything, so all the cash flows pro rata, 25, 50%, or so on? Let's look at how the different choices, A, B, or C, work out in terms of risk reduction. So we're looking at this slide, and we have defined on the chart on the top right that the company has an unhedged net income at risk of roughly 1.2 million. This is how much the net income can move under 2 standard deviation, assuming that the company is not entering into any hedging strategy. We then run the Monte Carlo simulation, seeing how this distribution of probability changes once the company is entering into hedges of CNY exposure. And in the graph at the bottom, we see that the company is moving from the distribution of probability, that is the yellow curve, to the green one, meaning that while before the net income at risk under the unhedged scenario was the point 1, the point that you indicate as number 1 on the chart, 1.2 million, after the company enters into hedges of the CNY, is moving to the point number 2, which is a level of net income at risk of 1.6 million. So by hedging CNY, effectively the company is widening the possible outcomes and is therefore increasing its net income at risk from 1.2 to 1.6. So we can determine that hedging CNY is not an effective choice for the company that wants to protect the net income. By the way, a similar result would have been obtained if the company was hedging US dollar. And in hindsight, this can intuitively make sense, because when we looked at the exposure of the company, we've seen that they have positive US dollar and negative CNY. And we know that these currencies are highly correlated between them. So hedging one currency would then remove the positive offset advantage of having US dollar and CNY in opposite directions. And these finding is actually very important because it's in clear contrast with the attitude that we have heard from some companies that we work with. Some of the treasurers might think that doing some hedging is better than doing no hedging. In reality, we can demonstrate that sometimes entering to some hedges might be non-productive and might be detrimental to the risk profile of the company. But if we move on the next slide, we can now see how the risk profile of the company changes by entering into pro rata hedges strategies. So hedging all the various cash flows, either 25%, 50%, or 75%. And on the chart on the right, we see that effectively hedging all of the currencies reduces the net income at risk. We also see that the more we hedge, the more risk is reduced. So we're passing from 1.2 million of net income at risk down to 0.65 million of net income at risk. But hedging every single exposure of the company might not be the best choice. If you think about it, it requires many transactions that operationally is not ideal. It might incur insignificant transaction cost, and it might require a lot of credit from the bank counterparties. So the real question is there a better way for the company to reduce risk? So what we do in the next step is we look at all the possible combinations of currency to hedge, and we divide them in 3 categories. The bad ones, like we've seen hedging CNY and US dollar, is detrimental for the risk reduction objective. We then have the neutral possibilities that do not have a very big positive impact on the overall risk profile. And then we highlight what the good solutions are. And as we've seen, hedging everything pro rata is a good solution because it reduces risk. But what we also see is that there are other options in the good category. For example, if the company was only hedging Australian dollar and CNY, was obtaining the same risk reduction benefit of hedging 50% of all the cash flows. And this is really powerful information because it allows the company to focus on the currencies that are the biggest contributors to risk, and therefore planning a hedging program that can be streamlined with less transactions, with less cost, and more manageable in terms of the operational side.
Paolo, if I
and this is a finding that can... Sure.
Paolo, if I could stop you there, in fact, trying to do this, though, does seem quite costly in itself. I mean, there surely is an argument to say, well, if we know what the cash flows are going to be, why not just hedge them all and forget the cost? Because this does sound expensive. And I have a second question here, which is about how reliable are these forecasts? We might be basing them on historical data, and we depend on the company. And we all know that companies are very dynamic. The sales are on one time scale, the purchases are on another, decided at different ways. How might that affect this?
Right, Will, thank you. And I will try to tackle your very good questions. So on the expensive side, I will probably tackle it from a different point of view. Clearly, the analysis does require some technicalities and some competencies in the areas of financial risk management. We mentioned the inputs that are correlations, volatilities, forward curves. So there is a level of knowledge that is required to perform the analysis. But when we put that in comparison with potential risk reduction objectives that can go, depending on the company, in the region of millions, then if you do a risk-benefit analysis, usually there is a good argument to go ahead and really assess the risks of a company. And moving on to the second point, the forecast. Well, you could be truly right saying that forecasts are never correct. And that is why usually in our experience, companies do attribute a percentage of confidence towards this forecast. Very rarely we work with companies that hedge 100% of their cash flow. So this level of confidence will determine how much to hedge. Companies might decide to hedge only 70% of the forecasted cash flows for the next 3-6 months, and only 30% of the forecasts that are further down the line. That will be depending very much on the nature of the business. So we have companies that can forecast very accurately, companies that have cash flows that are contractual, so very close to be certain. So just to conclude on this point, forecasts might not be right, but in many cases they reflect the structural aspect of a business that do not change overnight. So if a company is currently building its products in China, rarely this company can switch the production facility to another country and therefore another currency overnight. As if labor force is paid in US dollar, that is not something that can be changed very easily. So forecasts do have, depending on the nature of the line item that they're forecasting, might have some different level of confidence.
I would also add that typically we would really discuss with companies to look at hedging as your short to medium term solution to currency risk. Precisely like what Will and Paolo have discussed, there are other operational structural changes that companies can make to really change the full risk profile of a company. So you can change your facilities, your cost structure, but in the meantime, before that can happen, financial hedging is one way that companies can utilize to buy time to really make other business changes.
Okay, I think we've got about 5 minutes left for each for your next two cases, guys.
Sure, we'll leave it one for the second case study.
I mean, 5 minutes each, I should say.
Yep, so now on to the next case study. So we'll look at more complex companies in this one, and is a real company that we work with. Is a US-based company that manufactures windows, and they have about 100 divisions around the world with 20,000 employees across many continents. Given the complexity of the company, they are actually exposed to many currencies, as you would expect. So here you're looking at a snapshot of their forecasts for 2015. So at the beginning of the year or end of 2014, they look at what they would forecast for on the different currencies across the many divisions and subsidiaries. And this is a picture that really summarizes that. As many of you would expect, the currencies that the companies are exposed to on the revenue side would be primarily in the developed currency market. So you see the Canadian dollar, in the Norwegian kroner, the pound, Australian dollar, the euro. The one interesting thing about this very first assessment of exposures is that it really shines light on many misperceptions from the board's perspective, from the senior management. Given the recent headlights around the USD strengthening and the weakening euro, the board was really concerned about the level of exposure to the euro, because they had originally thought that they had major revenue in euro that would cause them a lot of risk. But when they go through the full analysis of what exposures are really in place across the different subsidiaries, they actually realize that they have a really good, decent offset within the euro itself, because many of their contracts in other European countries are actually denominated in euro on the cost side. So this very first assessment alone of just collating the data, putting together on their exposure and on their forecasts, already give a good insight into what are the biggest drivers of their risk. And the second point.
Anne, can I just ask you, are these cash flows that need to be settled in subsidiaries, or are they earnings, or are they cash flows that happen in the head office? How does that work in this company?
Yep. So this is from the consolidated perspective on the operating cash flow. So here you're only looking at revenues and expenses. Okay. And that's a. Go ahead, Will.
No, go
on. Yeah, and that's a great question, because as a background, the company that we're looking at here understands that the one metric that they care about the most is EBITDA. So that's what the board is really concerned about, and this perspective of revenues and expenses across all the subsidiaries is a picture that the board and senior management would like to have a good understanding of. So given that they have exposures to the more developed currencies on the revenue side, it's also a second very interesting takeaway for the company going through this exercise, that a lot of their currencies that they're exposed to on the revenue side are well correlated with each other. So this is a quick correlation table, and we're looking at a 6-month historical correlation here to really understand that for example, if the Canadian dollar weakens against the USD, it is likely that other major net profit currencies will also weaken, such as the Norwegian kroner, the pound, and Australian dollar. And given that in recent months and within this year, you've probably heard of stories of correlations breaking down, like the Swiss franc correlation with the euro. That is definitely a very dynamic measure that we're looking at here, and that's also the reason why many companies would also need to monitor it on an ongoing basis and refresh the perspective they have on the overall risk profile.
And can I just stop you there? 'Cause on that slide, there is an awful lot of numbers, and we've had a question as somebody would like to know how he could put together a particular table like that and start doing it himself. But I have a more fundamental question, which a lot of our listeners have also put forward, which is, well, don't these correlations just break down just exactly as at the time when you're depending on them to protect your earnings?
So that's a good question. So essentially, what we would argue for would be a very dynamic risk management approach, where, so in this particular example, this company is actually exposed to the Swiss franc as well. But the one good thing about the story is that they have already been in the process of hedging a portion of their exposures over a period of 2 years. So given that they already have some of that hedge, given the exposures and the forecasts from last year, they're in a better position than someone who might actually be unhedged. So again, like you can't always predict what adverse events of currency movement might happen in the future, but the one thing that you could always do is also monitor your exposures dynamically and have a process in place to really understand the level of impact any event could cause you. So even if you're not currently hedged, it's good to understand that your EBITDA might be at risk by 15%, for example, if there was an adverse movement in the currency market. So I think that's really the main focus of today's webinar as well, that companies should really go through the process to assess and understand the quantified level of risk.
Okay, and what about the question about somebody, how do they put together such a table as this?
I'll take you through a few quick numbers just to illustrate how the numbers work. So a correlation of 1 would mean that the two currencies move perfectly in tandem. So one currency appreciates, the other one appreciates. If one currency increases by 10%, the other increases by 10%. A correlation of -1 would be the opposite story, where one currency appreciates by 10%, the other currency would depreciate by 10%. So that would give you a sense of how the numbers are computed. So basically, you're looking at historical rates of the past 6 months, and you see how the two movements of the currencies going together or against each other. So if you look at a 0.62 correlation number between the Australian dollar and Canadian dollar, it means that if the Australian dollar appreciates by 10%, you would expect the Canadian dollar to appreciate by 6.2%. So that gives you a sense of how the numbers are coming together here.
Okay.
So moving on to the last slide of this case study that I want to put everything together, given the story around a really full understanding of all your exposures coming from your revenues and expenses across the many subsidiaries and currencies, and the level of volatilities and correlation of the currencies. This company has come to an understanding that the first 4 currencies, Canadian dollar, Norwegian kroner, Australian dollar, and the pound, actually contribute to about 65% of their risk. So what this tells them is that they can actually pay a lot more attention to these 4 currencies as opposed to getting distracted by 20 currencies. So then the next decision would be, oh, what can they do about these 4 currencies? Would financial hedging be the right decision, or would they have other fundamental changes they can do in their pricing and in their sourcing that can help eliminate some of this risk? So in the interest of time, I'm going to move on to the third case study and turn it back to Paolo.
Thank you, Anne. So we covered this case study pretty quickly, and this is about a real assignment that we've done with one of our clients. So this is a company that builds the physical infrastructure that enables communication via broadband and via wireless towers. So they operate globally in hundreds of countries, and because of its business model, it is a company that is exposed also to commodity, namely aluminum and copper. So we're familiar with the representation of the next slide. We have the expected exposures, and also we have highlighted the expected purchases of copper and aluminum. We notice mainly 2 things from looking at this graph quickly. Effectively, that aluminum and copper are amongst the largest exposures, and we know that commodities are also more volatile than currencies, surely more volatile than the major currencies. So potentially there is a high proportion of risk that will be coming from the commodities alone. We also notice that we have costs associated to commodities, but there are revenues that are in currencies like Brazilian real, South African rand, and Australian dollar, currencies that we know are highly correlated with the commodities. So these 2 exposures versus commodities and versus these currencies are in opposite directions. They are highly correlated to each other, so we would expect that they produce a good offset. So let's look now at the results of the analysis. So when we're looking at this, chart, we notice three things fundamentally. The commodities have a larger risk overall than the currencies. So the first bar represents the plus or minus 1 or 2 standard deviation of the EBITDA due to commodity price movement. The second bar in the middle is the movement of EBITDA determined by the changes in the exchange rate. And we see that we have an EBITDA risk, the left-hand side of the bars, that for commodity is $30 million, while from currency is only $8 million. So as we said, we notice that the risk from commodity is larger than the risk from currencies. We also see that the combined risk for the company, once we assess also how the currencies are correlated between each other, how the commodities are correlated to the currency, is lower than the sum of the two exposures. So as we expected, there is a good degree of beneficial diversification in the portfolio of the exposures, whereby the exposures on some commodities are offset by the exposures in opposite directions of other currencies. And final point that we want to highlight is that these distribution of probabilities are not symmetrical. We see, for example, on the commodity that the left-hand side has a downside risk of 30 million, while the right-hand side has a potential upside risk of 23. So this is mainly can be due to two different reasons. On one hand, it could be because of the forward curves and the volatility determining an asymmetrical distribution of the outcome. The other reason for that would be that maybe the company contractually can absorb or can transfer the price increase of commodities to the customers or from the suppliers in a non-symmetrical way. So really the message here is we need to look at the exposures in a very deep way in order to understand how truly the company is affected by the movement of prices.
Okay,
and
Paolo,
this is effectively the... Sure.
Paolo, can I stop and answer a question for you? We're running out of time, and I would quite like to get this one in. And that is that in case 2 and possibly in case 3, what you've got is you've got exposures all over the place and needing to be settled. And I think what you're proposing is an overlay hedge, in that you would do all these hedges in the head office because you're trying to do a portfolio basis. How do you get the gains and losses on those hedges back down to where they need to be, and those subsidiaries actually need to settle those cash flows?
So, Will, thank you. It's a great question, and it's a challenge to answer in a short amount of time. But I will start by explaining how we approach this decision. So we have looked at the quantification of the risk for a company. That is the first phase in the risk management process. The second phase is then looking how to then implement a hedging strategy, what strategy to do, how to hedge, how long for, what instruments, and so on. So once the company is aware of the risk that it's facing, the next decision becomes which exposures do we want to hedge. And the discussion within the company will be depending on many factors. Is the company repatriating or not? Does the company have liquidity risk and is so therefore concerned with the settlement of the derivatives? What are the competitors doing? Are they hedging? Are they not? Do we want to hedge so that we change the competitive landscape? Do we want to be an outlier or behave like our competitors are doing? Is the company having enough hedge accounting capacity to hedge some exposures or not? And how about the investor base? Do they want exposure to some currencies, to some commodities or not? So this is how then the information on the risk assessment is filtered in order to determine whether to hedge or not. And the practicalities around, should the hedge be done at the central headquarters, should be done locally by the company, it will be depending very much on the structure and on other considerations that ultimately the credit capacity of one entity versus the other, the tax and so on. So that will really depend on the structure of the company.
Okay, Paolo, I'm afraid that we've pretty much run out of time. I've got a whole load of questions which I wanted to ask, and a few more questions which our listeners wanted to ask, but sadly our time is actually up. I've got a few closing points that I must make. I would very much like you to spend some time to complete the survey on the webinar. Just a reminder that, and that will be available just after we've put the phones down. There will be a reminder. There will be a recording of the webinar available in a couple of days' time. And also, there's plenty more on offer from a very busy ACT. And the screen that you can see now has got some of those things that are actually coming up. And finally, thank you everybody for listening, and thank you to Chatham Financial, represented by Paolo and Anne, for contributing to the webinar. Thanks again, and goodbye.
Thank you, everyone.
Thanks, everyone.